Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, once again, I'm joined with my good friend, Doug Heagren. Hey, Doug.
Hey, Kirk. Good afternoon. How are you doing today?
Doing well, doing well. Well, we're in for another exciting Wednesday episode here. We're going to be talking about some hot topics here, but I want to first start with the new FAANG stocks. Now, we all remember the FAANG stocks of old. Old was 6 months ago. Where I think it changed a lot as things changed, but it was Facebook, it was Amazon, Apple, it was Netflix, and it was Google. And depending on how stocks did, sometimes they threw a few others in there, maybe threw a little Nvidia, and Facebook changed to Meta, so then you got to change that. Now maybe it's FAANG stocks. It got all confusing because everyone was trying to find this hot thing to buy, and there was a period of time where it really did well. But now that was FAANG 1.0. We're calling this FAANG 2.0 because there's a whole new set of stocks that are going to do well in the near future, and I really want to get into this. So I'm going to lay them out, and I want to get your opinion, Doug. So the new FAANG stocks that we came up with are financials, aerospace and defense, agriculture, natural resources, and gold. So if you really want the new FAANG Stocks 2.0, that's what we see as areas that you want to consider. So what are your thoughts, Doug?
Well, first of all, I like that the new FAANG replicates the old FAANG. We've got the two A's in the middle, of course, and hopefully they don't start changing gold to a new name, and this can make it a little easier. I don't know how long this is going to last. We've been on a heck of a bull run on the technology side of things, but I think it represents a lot of the things that we are definitely facing right now, right? So let's start with financials for a second. Federal funds rate, some of you may have heard of it out there. Maybe you haven't heard of it. But the federal funds rate is basically used to be what banks charge to each other in a world of illiquidity. If they needed money, they would charge this rate to another bank. The bank would pay them, would charge them this federal funds rate. They'd get the money, for the money they'd lend them. Well, after 2008, the government forced reserves to be super high and stopped banks from lending. So all of a sudden, banks had to sit on all of these reserves. Well, guess what? That changed what the federal funds rate is now doing. And now the U.S. Treasury the Federal Reserve is now actually paying banks for that money they have in reserves. Why does that make financials interesting? Because these banks basically are getting about $150 million a year. Just to sit there and collect interest on those reserves that they have. So yeah, I mean, it's certainly going to help their bottom line when you think about the money that they will earn with rising interest rates, but no risk. We've got Russia, we've got Ukraine, we've got food shortages. Obviously, we've got resources right now, commodities they're trying to pump out to make things run. How do you get at that? How do you get at that when there's not enough supply? Obviously, gold always comes into a question when we start to have uncertainty in the economy. So I definitely can see reasons why a lot of these have the potential to be successful for the foreseeable future.
Yeah, I want to touch on a little bit more on financials in a second, but I just want to say, it's not the exhaustive list. I mean, we did this kind of in jest because, people were talking about FAANG stocks for about 10 years. But in reality, there's other things that also belong in there, like utilities and industrials that should also do very well. Really what it comes down to is it's really value stocks. Value stocks are going to be the area to be in with a rising interest rate environment. Now, obviously, we don't know the future. We always have to say that every show because I think everyone naturally gravitates towards trying to predict the future. And certainly we're not saints either. We do that sometimes too, but I think we all have to acknowledge the fact that we don't know what's going to happen. The Federal Reserve could come out tomorrow and say, "Oh, we made a mistake. Hold on, we're going to lower rates again. We're going to start doing QE because the stock market's down 20% and the world's going to end. So hey, we gotta lower rates." I think that's highly unlikely, but at some point that could happen. They're already alluding to the fact that they might lighten up in around January of 2023, which of course the market is discounting now, which is why the market's going up. So if you're wondering why the market's bouncing off its June, July lows, that's the reason. Because people think in January the market's going to be higher because the Fed's going to loosen up their policy, maybe even lower rates. I think that's ridiculous. If we have inflation at 8.5% like we have now, or in Joe Biden's terms, 0, if we have 8.5% inflation and that continues, and maybe it's not 8.5, maybe it's 5 or 6. And I will fully acknowledge that I think it's probably going to be lower than it is now, but 5 or 6 still high. And if you think 5 or 6 is okay, and we have a 2.5% Fed funds rate, that's still a big problem. Right? The Fed funds rate still needs to be around 5 if the rate's around 5 or 6. So that's a long way from here. So if the Fed's going to lighten up and just see what happens, we'll probably have another round of inflation, and they'll have to raise rates again and the market's going to dip. This is why we see this bullwhip effect. And this is going to happen just like it happened in the 70s. It's not going to mirror it. If you're trying to overlay a chart like some chartists do, they're going to take a chart and they're going to say, oh, look, it's just like the other one. It's not going to be exactly the same, but it's going to be very similar. So you should expect the fact there are going to be ups and downs. There are going to be chances to profit from the ups and the downs if you're a nimble investor. If you're not nimble, then you should probably take some risk off the table because, frankly, there's a lot of risk out there that's not being accounted for. But really, getting back to that, so really value stocks do well in a rising interest rate or a higher interest rate environment. Growth stocks, or typically value or FAANG stocks, do really well in a low interest rate environment, because it's cheaper to borrow money. And so that's kind of the dynamic that's at play here. And if you want to know why, if you're investing in technology and thinking, hey, it's down, it's going to do great. Yeah, you might eventually be right. And the fact that it's gone down so much, the NASDAQ and a lot of technology stocks are down a lot. Yeah, sure, they might come back and do well. But the problem is at the moment, the underlying conditions are not supportive of technology stocks. So it might just mean you just have to wait, right? And that's okay too. They're not bad companies. They just might not, knock the cover off the ball, as they say, in the near term. But I want to get back to financials because, Doug, you mentioned financials, and there's a lot of elements at play. I know late last year, people thought that that financials were going to start really doing well because it's been so long, and yet they haven't. And so a lot of people were puzzled, but there's so many dynamics at play. And I know you mentioned some, and I want you to go into some more. But one of the ones that I see that's a problem is the inverted yield curve. So the yield curve is basically, I don't want to say it's created for banks, but banks, their structure depends on it. And it depends on the shorter term interest rates being lower than the longer term interest rates. Because what banks will do is they'll borrow money in the short end. They'll borrow money at, whatever rate that they want. Let's call it, 3 months, and they'll lend it at 30 years, right? So they're taking advantage of that spread. Now, I know they don't actually do that, but I'm just giving you an example. So they're looking at that spread and saying, we're going to borrow short term with low rates, and we're going to lend long term, and we're going to take that spread, and that's our profit. So that's how they make money. But yet with an inverted yield curve, you have the longer term is lower than the shorter term, which means that they can't lend out and make money. So what happens with that, Doug? We saw some news recently to the effect of what's going to happen there. So how does that play out?
Well, I mean, if you take a look at the cost of that, I mean, we're already seeing companies like Wells Fargo, who has been a mainstay in the mortgage industry for, I mean, as long as I have been in my working years, going back, 20 plus years, Wells Fargo has been one of the primary lenders in the mortgage space, and now they're exiting it. They're realizing that, hey, this is not a future. And I think, Wells Fargo, going back to what we said before, if that Fed's funds rate does get back to 5, Wells Fargo and a lot of the big banks, U.S. banks, the Bank of America's out there, they're going to sit really well on those huge reserves and get paid to basically do nothing. And that gives them flexibility to be able to pause. But what we're seeing is those banks that are out there that are exclusively dedicated in the mortgage industry. I mean, not to knock bad business models, but I mean, I think most people would agree that the mortgage industry has been fantastic for the last who knows how many years because of low interest rates and all the refinancing. All of a sudden it comes to a stop. Early this year, rates go up, and now all of a sudden, people don't want to necessarily go out and get a new mortgage now. Here we are 6 months later, and there's talk of major collapse in the mortgage industry. I mean, what have these companies done with all the money they've made over the years? Because now, not only does it not make sense to give out new loans because it's too expensive, the demand is dropping on them as well, which is going to cause some significant chaos. Now, let's not get too panic on the financials industry, because overall, as a broad spectrum, when you go back to after 2008, I mean, the federal government essentially told these banks, you were lending too much money, you got yourself in hot water, you weren't managing risk, so they just swung the pendulum in completely the different direction and told them basically you have to have these massive reserves and all of these loopholes that people have to jump through to get money. That's why, more paperwork to get a mortgage, more restrictions, and banks just effectively, have gotten much more stingy at giving money ever since the Great Recession. And what does that mean? Well, it means you turn around and they sit there and they look at the Fed, who's telling them, yeah, the last couple of years, especially during COVID, please give out money. And they said, well, we can't. Look, we got these restrictions. You want to raise those restrictions? They said, well, the Fed said, fine, we'll raise them. But the Fed also completely backed up every one of those loans. And if you're a bank right now and you're looking at a situation where, you've got these restrictions, and if interest rates keep going up, you're going to basically be paid to sit there on cash. What's your motivation? And, talked about banks being kind of a place that people thought were going to do well. I think there certainly was some concern with the mortgage industry about how that would affect some of their bottom lines, because they're going to be sitting on money that isn't going to pay them anything for the next 20, 30 years. It's another reason why, maybe paying off your mortgage a little quicker might be a question mark, because all you're doing is giving that money back to the bank. And trust me, they love that, which is why you get a little bit of an interest rate reduction. But ultimately, again, this is pure opinion and speculation here, but it makes you wonder if the new paradigm shift in banking is, that, gosh, we're not really going to be in the lending industry anymore. Why? Why should we take risk when we can get paid for no risk? And ever since 2008, it's almost as if banks have been trained to say, look, we're only going to give you money if the Fed 100% backs us up, which in that case, if the Fed's not backing them up right now and is going in the opposite direction, there goes your money supply. Of course, we need to take a lot of that out of the economy anyway. But, if you need money, that's going to be an issue. But I think that leads to the other areas too, because what you list in those new FAANGs is a lot of companies that are capitalized. Gold is obviously not a company, but that I think is going to be a huge shift going on here, because technology, you talked about it, low interest rates, they're growth based. They just need money. They don't need profits. They need money to invest and to grow and grow. And they live off discretionary revenue, right? A lot of technology is not something that is a necessity per se. I mean, you don't need Netflix. You don't necessarily, you could argue a couple of different ways and where they're spread, need Google. You don't need social media. And it's deflationary in itself, because new technology comes out and drives the old technology down, which is why all these new big tech companies are just buying the small guys. And so now capital is hard to get. You can't just grow. You can't get that money to keep expanding. Well, guess what that means? Well, before, nobody wanted highly capitally intensive companies. They're not sexy. They're not going to grow. They just got stuff in the ground. Well, now if you are trying to get more profitable, if you are trying to build new things, it's really expensive to do that now. Again, the banks aren't lending, the Fed's not lending, and even if it can, you're going to be charged a tremendously higher interest rate than you used to. Okay. So what does that mean? It means that the things that may not have been, highly coveted before are going to become more coveted if they are highly capitalized. That was not a great place for investment before, but it may be now, because listen, if you've already got the equipment, if you've already got the buildings, if you've already got the infrastructure, and you can just sit there and not have to spend a lot to make money, all of a sudden that profitability is going to be really, really important in a time of illiquidity. And the last thing I want to say on that, of course, is the commodities market. One of the things we're facing here is supply and demand for an economy that started to reopen again. You talk about the bullwhip effect. The last 3 years, there was no investment. Go back to 2019s of the world and before that. I mean, the Balkans, right? How much US oil was being pulled out of the ground. It became so profitable to go get new oil that everybody jumped in, and that drove all the prices on oil into the basement. All of a sudden, COVID comes, everything shuts down, oil's not being used anymore, drove a ton of them out of the business, and nobody was going to invest in it. Now, all of a sudden, everybody needs oil in, no new investment in 2-3 years. Why do you think it's expensive to get it?
Yeah, no, I couldn't agree more. I appreciate your thoughts there, Doug. And I have some follow-ups here too, which this is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today. You know, as I'm thinking about this, maybe we should change the FAANGs around to some other names, or even come up with a new one for next show. Because you know, the financials, I totally agree with you. I think the financial system is broken in many ways. At least I shouldn't say broken, but it's broken compared to the way it used to be. And I'm not sure that way was better or worse, right? Because if you can just give your money to the Fed and you can get a huge dividend every year, why would you do anything else? That seems like a great business.
Sign
right?
me up. I do it.
Seriously, I want to go start up a bank. But I think it does bring up the aspect that being a financial institution is actually a lot harder now. And I remember, I think I mentioned this in the show in the past, I tried to refinance my condo years ago, and it took me 9 months to do it. Not because I wasn't qualified, but because I was a business owner. And if I was a W-2 employee, they would have just sent it right through. It would have been, the guy told me, he said, not a problem with all the numbers you have, but because you're a business owner, we need all of your tax returns. We need all the business tax returns. We need your, your firstborn, we need your blood type. Like, I mean, they needed everything. And I was like, come on, man, like, what are you doing? And they're like, this is the way it is for every business owner. I mean, I have a friend who's making a few million a year. He's got a very simple business. He wanted to get a home with a mortgage for his mother. He would just want to buy his mother a home, just somewhere she could live and retire. And the bank's like, sorry, we can't give you a mortgage. He's like, why? I've got like 2 million in the bank. I've got like plenty of great financials. They're like, sorry, you haven't been in business for 2 years. He's like, you gotta be kidding me. Like, nope, sorry, can't do it. So it's that kind of ridiculousness. And I know banks have always been a little bit silly about some of their standards. In the past, like if you got, for instance, if you were trying to get an 80-20 mortgage, right? 80% mortgage, 20% equity, which is what most people do when they buy a home. If you were trying to do that, that's standard, right? Let's say you got a 5% mortgage on that. Well, if you put down 50%, you'd think, well, their risk is a lot lower. So why wouldn't they give you like 4% hypothetically, right? And there is a point where they will consider that. But if you only wanted to borrow 20% and you had 80%, they're not going to give you a lower rate. It's like they're not accounting for risk in the way that normal people would. Now, granted, they have a different model to worry about, but I look at that and say that's a broken model. If I were to start a company, just like a virtual crowdsourcing company where I said, hey, you can get your primary mortgage here and your rate is going to be dependent upon your loan to value. The lower the loan to value, the better your rate. Because if I'm a lender, I would say, great, yeah, I'll give them a lower rate. Absolutely. Because what's my risk? My risk is that they're going to default on 80% of their equity. That's crazy. Nobody would do that. And even if they did, I'd be happy to refinance because it's a good risk. But the banks are not structured that way because they're not allowed to in many ways. So, I want to come back to this. When I said financials, there's actually a bunch of financials that are not necessarily banks, like insurance companies. We haven't talked about this in the show in a long time, but one of my favorite asset classes is property casualty insurers. If you choose those right, they're a great long-term investment, but you have to buy them right. You have to get them at the right price. And if you do, I think you can really do well. The problem is nobody understands how to price these things. Even people on Wall Street, they don't really truly understand property casualty insurers. I mean, I've seen people value them and they're all over the map. And it's not that these people aren't smart. They're super smart, but they don't understand how they work at a fundamental level in order to value them. And I have found a handful of people that are really good at it. And you can't really find these people because they don't want to advertise how good they are at analyzing these companies. But I think that's a great example of a company that fits in the financials that you're never going to hear about on mainstream media because it's complex. Now, I do want to point out that there are a few others that actually fit in there. So we put natural resources for the N, but I'd actually also include nuclear. So, you know, people here have listened to me talk about nuclear in the past, and it's one of those things that really makes me angry, because nuclear is probably one of the best clean energy sources out there, and yet no one wants it. The you know the green movement people, they don't want it, and yet it's one of the best examples of something that would solve some of the problems that they're running around screaming about. And even the conservatives that maybe just don't necessarily believe in the green movement, even they're for it because they see the benefits. So it's like everyone can get on board with this. It helps everybody and it solves everyone's problems. Yet at the same point, no one's backing it, and it's like this political third rail that nobody wants to talk about. And yet it's probably the one thing that could solve all of the problems that everyone is screaming about. So I do want to actually, because we don't have the time to talk about this week. Next week, I want to go into this. We're going to have a little clean energy versus dirty energy debate here between Doug and I. And I really want to dive into this because it's such a great topic that most people just don't know about, because there's just these talking points on TV that are just regurgitated. No one knows what they're talking about. No one's done their homework. They just keep saying it because it's the thing to say. And I think if you really dig in and know what's going on, there are people on both sides from both parties that are on board with this, and they're not getting a lot of airtime. So, I think it's kind of like the opportunity zones. This is a bipartisan supported bill. The opportunity zones is a great part of the tax code, is bipartisan support. And I think if you could do the same with nuclear, you would get immediate change in a lot of the challenges that people are fighting over. And quite frankly, maybe that's the reason you're not hearing about it, because then you're not going to pay attention to the people supporting the green movement, because you'll solve their problems, right? So I don't get me down that road, because I could go a long way, but I think that's something that we need to discuss, and I know we're going to discuss it next week, so I'll leave that there. So, Doug, in the interest of time, I know we have to run, but last thoughts from you about this.
Yeah, I'm glad you brought up the financials was more than just the banks. I mean, insurance companies, you mentioned one thing that, again, it's a love-hate relationship with insurance, but they manage interest rates probably better than anybody on the planet. That's what they are. And so if you take a look at, back in the 1980s when interest rates were paying 18, 20%, everybody wanted insurance, right? One thing that is, if history repeats itself, the one thing that has tended to prove true is that if interest rates go up, insurance companies will do very, very well. Obviously we've got, political conflicts that are happening that can play really well into the aerospace and defense. When you start to look at, where things are going to be, happening in terms of commodities. I do want to make a couple things that just came out. Some interesting points came from this report. It's called the Sevens report, and this is a good way to end on this. I mean, there's been a huge rally this year, 13% just under 2 months. There's ideas of peak inflation and peak Fed hawkishness, right? That's going to finally get to a point where maybe the Fed will start investing in growth. But a couple of things that came out today, I think that are really important to close on. And here is number one: oil had recently dropped below $90 a barrel. And it's not because of new supply. As I said, there's been no investment. It's because demand expectations are actually falling more sharply than they anticipated. That is definitely not going to, if the commodities believe that the Fed was going to turn less hawkish, this wouldn't be happening, right? So the commodities markets definitely think that the government is still going to be fighting to slow things down. US dollar is higher than it used to be on a favorable CPI report. Listen, if the currency markets thought the Fed was about to turn less hawkish, the dollar would probably be going down. Right now, you got the 2-year Treasury yield. That's been breaking out to new highs. Again, if the bond market thought that this was going to be a sign of the Fed turning hawkish, those yields would probably be going down. And lastly, the 10s and 2-year Treasury yield spread sits at negative 45 basis points. You were talking about that. That's just off a recent low of negative 50 basis points. That's the lowest level in decades. If the Treasury market thought the Fed was going to turn less hawkish, then it would probably be moving closer towards zero. So you mentioned in the beginning of this that, you know what, things may feel a little better right now. Kirk, I think just to summarize things up, where capital can work for you, where things may be more predictable. And honestly, right now, I would still think about keeping more cash, like those that are trying to pay extra money to pay off their houses, do all of these things. you mentioned something. You could have $2 million sitting around, no job, and the banks aren't going to give you money, right? So have capitalization right now and be prepared that we're still, it may look it may look calmer, but the calmest part of a hurricane's in the middle of the eye. And we don't, and so the wall may just be about to pass over us again. So
that's true. Well, Doug, where can people find more about you?
Thanks, Kirk. ProCollege Planners is a great place to start. If you have kids that are, looking at going to school in the next 4 years, FAFSA season's coming up. October 1st is when it opens. So if you've got a senior that's, rising senior this year, this is the time in which you can, you need to go out and apply to FAFSA. Now, many of you out there say, well, I make too much money to make money. Why would I ever apply to FAFSA? Listen, if you don't apply to FAFSA, you can't get merit aid for most schools. If you don't do the minimum things that you need to do, you're going to leave money on the table and you're going to leave it for someone else. So here's a big myth. If you think you make too much money to get any discounts for college, you couldn't be more incorrect. Learn about how you can get money for college and discounts, cut the cost in half, maybe even get a full refund on college, even if you feel you make too much money. And you can learn more about it at ProCollegePlanners.com.
Awesome. Well, thanks for coming on, Doug. And I highly suggest people check that out if you have kids close to an age in college. So, I just want to follow up on one point, and then we're going to wrap up the show. Is, Doug was talking about, oil prices going down. I think what's interesting now is a lot of the dynamics have changed in the last, in the last few months, where everyone thought inflation was just going to take over. And now we've gotten to a point where things are subsiding a little bit, right? So fuel costs are going down a little bit compared to where they were before. And, really what the market's doing is the market is digesting a lot of what's happened. And this kind of comes back to the bear market effect, which it really is, it's hard to predict because, we had a big sell-off first half of the year. The markets were down between 20 and 30% for stocks and bonds. In many ways, it was just a rough year for everybody. And the second half, they're starting to pick up a little bit, which is interesting. But right now, their future, the market's based on future expectations. So the future expectations now are that energy prices are going to go down because we're going to go into a recession, which means less demand for fuel costs. Now, that couldn't be further from the truth, but that is what people are expecting. So the fact they're expecting it means everything else is changed around that point. So oil prices are dropping. You look at the stock market. The stock market is pricing in the fact that the Fed is going to start easing in January of 2023. They think rates are going to start to go down, or at worst case, stop going up. And the Fed has actually acquiesced to that recently and said that, well, we're probably going to start to ease at some point in the future. Well, they didn't say when, but the market is assuming that's in January. So what all that means is the market is a forward pricing mechanism, which means that right now it's pricing in the future, let's say about 6 months from now. So just understand that this is a work in progress, as it always is with the market. And if there's going to be a recession, the market's pricing in the fact that the Fed's going to maybe lower rates, which means the market should go up. So it's, if you really want to understand how the market works, it'll swirl your brain because it doesn't make sense unless you're really good at this kind of future think kind of mentality. But, as we always say, just, find your own investor psychology, find a good strategy that works for you and stick with it. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.